Hello and welcome. This is the Insurance ProBlog Podcast. This is episode number 425.2. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about life insurance.
That's right. We've determined that the internet doesn't care that much about podcasts about life insurance, but, you know, we just keep doing it anyway.
That's okay. That's all right. We're here. We're not going away. We're like Chinese water torture to the internet.
Ooh.
What we do.
Just a slow drip.
Yep.
Well, one of us forgot how to do podcasts last week, so we took a Memorial Day holiday.
Yes.
We weren't actually planning on it.
We weren't, but now we have episode 425.2, which replaces 425 because one of us recorded episode number 425. The other one did not.
Yeah. Well,
and
we'll just leave that to everyone's imagination as to who's who. So.
So here we are today. We're not even talking about the same thing that we recorded a podcast for last week because
why would we do that?
Decided, we're going totally different direction today.
We don't want to talk about the same things twice. That's an inside joke.
We don't need to make this any more boring than it already is. Oh, today we want to address the issue of risk management with life insurance in your retirement portfolio.
Yeah.
It occurred to me as I was saying that I could have jazzed that up way more than I did.
Yeah, you could have made it sound more interesting. The secret tool in your portfolio.
Years from now, people will be like, who's Ben Stein? And somebody will explain it to them. Like, or if you want to, you could listen to these two idiots on the internet talk about life insurance every week. They've basically replaced him.
That's your new tagline. Brandon Roberts, the Ben Stein of podcasting. Ben Stein probably has a podcast. I don't know.
He does, probably. So
anyone?
Oh boy, we didn't really take a week off, but it feels like we did with this.
Yep.
So when you're trying to build a retirement plan, a portfolio, there are an array of risks that you face.
Mm-hmm.
And
we use the portfolio term. We're casting a wide net. We don't mean like your retirement account per se.
No, because in our eyes, the notion of accumulating assets in a portfolio ultimately for most people means retirement, but that not necessarily explicitly in the vein of you get to 65, you stop working, and here you go. You have your retirement account.
Right.
Your IRA, your 401k.
Right.
We mean it more in the sense of you are out there actively investing for the accumulation of something. Income is kind of the big thing for most people, or at least it will be once they get old enough to realize it is. And at that point, you have the ability to support your lifestyle with your assets.
Yep. Always, I have a corny visual. The way I think about it when I say retirement portfolio, I think about remember those awesome leather portfolios people used to carry back in the 80s and 90s that had the little snappy top to them?
Or the late 2000s if you were Brandon and you got one from Guardian Life and you used it.
Pleather, the finest pleather they had to offer. But I think about one of those, you know, and it's filled with all of the things that will provide income for you when you are no longer working. So that could be accounts, that could be policies, that could be annuities, that could be real estate, that could be, you name it. Part-time job, whatever.
Yep.
Those are all, in my mind, part of your retirement portfolio. So I just want to expand people's thoughts as to what we're talking about. We're not looking at a specific account in this context. We're just talking about how cash value life insurance fits into that sort of a all-encompassing, I have a portfolio full of assets that are going to provide for me when I'm retired.
How life insurance fits into your Trapper Keeper.
There you go.
So the various risks, and that's actually a very good point, that there are so many assets involved.
Yeah.
And a lot of people think, oh, it's the stocks. Well, it's the mutual funds in my 401k.
Right.
And no, there's many other things you might own that are going to have a part in your portfolio for the sake of financial resiliency and eventually retirement. It could be something like you bought an apartment building and you collect rent.
Right.
That's part of a lot of people's retirement portfolio.
Right.
So there are an array of risks that we face when we go out and we acquire assets, either because we're trying to grow our wealth or we're trying to build additional income sources.
Yep.
And we think that life insurance acts as a really, really fantastic buffer against a number of the risks people face, the biggest issues people face when it comes to risk. And when I say risk, I mean threat of solvency, threat of loss, threat of the ability to carry on the lifestyle you want to carry on because there has been some event that has caused impairment to at least one of, in many cases, more than one of the assets in your trapper keeper.
Yeah.
So we're going to run down the list of risks. We came today with 7 of them.
Ooh.
And explain why we think life insurance acts as such a great shield against those various risks.
Inside of each one of those. Very detailed. Very detailed.
So the very first one is one that we have talked about a few times in the past.
Not to repeat ourselves.
No, not at all.
But we're going to.
But it's a big one. And it's one that we talk about because there are always people coming to the podcast and going. And it's one that bears repeating even for the ones who've been around for a while. So we're going to start with sequence of returns risk. Because we keep saying it every week. Well, not quite that often, but a few times a year. And we keep running into situations as people come to us and they don't understand what this entails.
Right.
So the notion of sequence of returns risk is
not
that
because it's that hard to understand, just because it's not something that people talk about all that much.
No. And it's also something that you really don't have control over. And that is something that people have a difficult time accepting and understanding.
Right.
So sequence of returns risk is simply the notion that the order of various events matters.
Right.
The timing of returns, for example, of the stock market will have a dramatic impact on what you can ultimately do with the assets that you have in the stock market.
Right.
So sequence of returns risk says if bad market years happen at certain times, that will have an impact on your portfolio that will irrevocably change what you're ultimately able to do with the assets that you are accumulating that are subject to whatever risks are imposed to those assets.
Right.
We often talk about this in the context of the stock market because one of the easiest ones to paint a picture with.
Right.
We have tons of data we can show you. Look, stock market returns are bad when you start retiring or the year that you retire. That's going to cause an acceleration of downward pressure on your account balance, which is dramatically going to affect how you can generate income if your strategy is something like, I'm going to sell 4% of my portfolio assets to generate income.
Right.
So the nifty thing about life insurance is when it is used in a risk management sense for something like sequence of returns risk, life insurance doesn't care that much about when various rates of return or events take place because life insurance comes with the really cool feature of not being able to decline in value because of any economic event unfolding.
Right. Yep.
Whole life insurance is going to earn guaranteed interest and in most cases dividends because it's very solid in that sense. Index universal life insurance does not go negative in terms of the interest paid because the market is down in the index that you're following. You were starting to say something and then I rush
No, I
in
was just going
to
to
that
say,
point.
yeah, with the next universal life insurance, you could have a 0 year or a minimum year, depending on if your policy has any sort of minimum guaranteed interest that gets paid. Some have 1%, some have 2, most have 0. But you're not going to run into an issue there. And then with whole life insurance, that's not to say that your returns couldn't vary from like an original illustration, of course, because dividends go up and down and internal company expenses and blah, 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 blah. But so the year over year number is not necessarily going to be the same as a percentage rate or guaranteed fully. But you do remove yourself from the risk of having a negative 22% year.
Yeah.
Which I don't think it's hard to understand the impact that has. I know there's one of the more famous things that people will say in the investment retirement, world out there on the lines, so to speak, is, you can't time the market, which I don't disagree with necessarily. I think there's some caveats to that, but in large part, they're not incorrect. That's not an incorrect statement. But I can flip that around and go, but the timing of the market definitely impacts you.
Yes, it does.
Can very much dictate. We have seen firsthand this happen to people. Can definitely dictate the amount of money that one might decide to take from their account in a given year. So that's all I'm going to say about that. I don't want to get too specific, but
yeah,
it matters.
It does. It does.
And this is one of those illustrations you can find them anywhere. I don't have to walk through them, but always sequence of returns risk is the actual risk that you face, not because what most people focus on is the average annual return. They'll look at something and go, well, it's averaged 8% over the past 32 years.
Yep.
Okay. That math computes. However, look at each individual year and see what happened. It doesn't always mean that just because something, you and I start at different points, we could actually have the same average return for what it, just by happenstance, it works out that way. But that doesn't mean that I'm in better shape than you're in. You could be far better off than I am.
Yes.
Depending on how that sequence played out in your individual circumstance. And you can't control any of that.
Nope.
No one.
No, you can't. And in addition, you don't even have to have different start and end points. You just have to have different assets.
Yep.
Because a lot of times we talk about this in the context of what the general stock market has accomplished, which for practically everybody out there means the S&P 500.
Right.
So a ton of examples use something like, had you invested in some sort of index fund or index ETF, this is what the results are. This is what the average is. But the truth is, in practice, very, very, very few people concentrate all of their retirement account investments in an index fund.
Yep.
They tend to have other things in there, and that changes the rate of return you experience. And depending on what sectors you're exposed to, may significantly change what your results are, not because there's any sort of massive economic decline, but because there's a sector you're overexposed to that just had a bad year.
Right. And I want to go back to something you said. This is not unique to the stock market.
Nope. You could be heavily invested in real estate and experience a sequence of returns issue.
All assets have a sequence of returns issue, risk issue with them. It's easy to talk about the market because we have lots of data. It's ubiquitous. It's something everyone understands to some degree. They have some familiarity with it.
I'll give you, for instance, and then we should move on. Real estate being one, and we'll talk about it in the context of REITs. REITs got hammered after COVID.
Yeah.
And the reason is because interest rates went up, and then we had, of course, tons and tons of real estate just kind of shutting down, sitting vacant. So we had profitability of REITs going down, but then we had interest rates rising quite dramatically. And a number of people invested in REITs said, well, I don't like the prospects of generating income moving forward. And I also see treasuries ticking up in terms of what they're paying, which is good enough.
Yep.
So a whole bunch of demand left REITs, which pushed prices of REITs down. So if you owned REITs and part of your strategy was to sell them for gains, you went through a sequence of returns problem if that was going to be the beginning of your move into something else or generating income by selling shares of REITs or something along those lines. Same problem, but not a market-wide calamity.
Yep. Agreed. Okay.
Tax policy.
First point done.
First point done. If we keep that up like this, it's going to be the
hour and a half long.
It's going to be a quick 2.5 hour podcast.
Yeah.
So, tax policy. Tax policy is a much bigger risk than most people are generally thinking about.
Yeah.
For retirement. Because what they don't realize in most cases is I am saving money, let's say in my 401k. And even though we have the advent of things like Roth contributions to 401ks, we've had Roth IRAs for years, still the default option for a large number of people is a traditional, which means deducted contribution 401k.
Yep.
So they've taken a deduction on those saving contributions and they have a pot of money that once distributed will result in ordinary income being recognized to them and then having potentially a tax liability on that distribution.
Right.
That.
And I will say, like, you brought up the Roth 401k contributions nowadays and Roth IRAs. And we see lots of those, by the way. But I will say that the vast, vast, vast majority of people who are sort of in the realm of retirement, meaning they're already there or they're within 4 or 5 years.
Yep.
I don't have exact numbers, but way more than 80% of the money is traditionally tax deferred.
Yep.
So, because those options didn't exist when these people started working and for most of their careers.
This is true.
And the Roth, if you remember back, the Roth, I'm not even talking about the Roth 401k option, but the regular just Roth IRA for years had a very, very, very restrictive income limit.
A restrictive income limit and just a restricted contribution limit.
Yeah. So most people haven't accumulated tons and tons of money there.
No, they haven't.
All right, go ahead. Sorry.
So when you have a pot of money that is taxable when you withdraw the money from the account, you are now hoping that tax policy is not going to become less favorable to you in retirement.
Right.
Now, there are a legion of people out there talking about things like deficit spending and federal policy and telling you there's not a chance on earth that tax rates don't go up from here. I'm not here to sing that song. All I'm telling you is tax policies can and do change.
Yes.
And if the assets that you hold are going to be taxable upon distribution, you are subjecting yourself to the risk that tax policy is less favorable to you when you need the money, which could mean you have less buying power from that pot of money.
Right.
That is not an advocacy to take every dollar you've got saved and convert it to something like a Roth.
No.
We've done numerous analyses on that, and quite frankly, Roth conversions are way oversold. What we are advocating for, though,
we don't know if they are in actuality, but the lip
marketing.
service, yeah,
the marketing is way oversold. So the advocacy here is have a position that is not going to be subject to the whims of tax policy.
Right.
Life insurance enjoys a multitude of tax features, tax benefits that are extraordinarily favorable to retirees.
It's black and white stuff. It's not a gray area.
Correct. This is very, very time tested. These are not things that you're going to have to hope you don't get an audit for and defend yourself in tax court on. There are no question marks about how this works. Distributions, withdrawals from life insurance, if there's basis, are non-taxable because they are recovered first before any gain is touched. And loans issued against a life insurance policy from a policy loan are also not taxable provided the policy remains in force.
Right.
This is a very simple way of minimizing potential tax liability just from ordinary income. It's also a very simple way to avoid taxability of Social Security.
Mm-hmm.
Because life insurance distributions do not count towards the calculation that determines if your Social Security income is taxable.
Right.
Okay. Liquidity concerns.
Ooh, that's a fancy word.
There are going to be assets that are not always easily liquidatable for a number of different reasons.
Right.
We've already brought up real estate, which is a great example.
Mm-hmm.
But there are also times, and this kind of gets into the sequence of returns risk discussion, when an asset that seems easily liquid may not be as easily liquid because something has happened to not make it a good time to sell it.
Right. Meaning you don't want to be dependent on having to liquidate said asset to provide an income for you to live.
Yeah. Or you don't want to liquidate said asset because an emergency expense has come up. And normally it wouldn't be so bad, but I don't want to sell more of this thing because something has happened that it's just not a good idea to sell it right now.
Right. Yep. I can't think I'm going to make a broad statement and I can't think of any way that it's untrue, but maybe there is.
Okay.
Most assets that are sellable, meaning they can be liquidated, are subject to a market of some kind.
Mm-hmm.
So markets ebb and flow. That's just the nature of it. I mean, real estate's an easy one to talk about because everyone's familiar with real estate for the most part. And I'm trying to pick a date. In April of 2020, not the best time to probably sell a piece of real estate. Would have been a little tough. By April of 2021, you could have sold it for a whole lot more than you could have in April 2020.
Yeah.
But you had to have the luxury of going, oh, I'm not going to sell it now because now timing's not right.
Right.
You don't want to be in a position where you have to.
No, you don't.
To survive.
I've mentioned before, we've got a story with a client policyholder who had an opportunity to make an investment. This was years ago, who didn't want to liquidate any stock holdings that he had because it was I cannot remember the year. 2018, I think, was just kind of a blah year for the stock market. 2018, 17, sometime in that time frame. And so things weren't down a lot, but they were down a little. And he was looking at it going, this isn't a good time to sell these things. So used a life insurance loan.
Yep.
To make the investment.
Yep.
And was mighty happy to have that opportunity on the table. And this is not a retirement situation. This is I'm working and life's great. This thing has fallen into my lap and I would like to take advantage of it. And I don't really want to sell stocks that have been beaten down to do it.
Right.
Didn't have to. So liquidity comes in a couple of different forms. Mm-hmm. Some assets are just harder to liquidate. Again, real estate. And some of that just has to do with transaction time.
Right.
So
maybe it's a collector car. We'll pull something else out of the.
Yeah. You're going to have to spend some time putting the word out that it's for sale. And you got to find the right buyer in that case.
Yep.
So next risk is wealth transfer. Passing your assets onto someone else is a far more complicated process than most people tend to realize. And we don't generally get a good sense of the complexity of this until somebody, generally our parents, dies or the last one dies, and we get to see what the hassle is to get everything over to us or our siblings.
Yeah.
And go through that.
And we're talking about in situations that you and I have witnessed where these are not people that died without wills or without planning documents. These are situations where all those documents existed and it still took months, if not years. I'm personally aware of some cases where estates remain open for years because of one thing or another. Something's caught up in probate, or five. The classic one is 5 people own a piece of real estate, 4 of them want to sell and one doesn't. Those sorts of things happen. And one of the things that people don't count on when someone dies is the need for money.
Yeah, because there are certain expenses, certain bills that
They
come
don't
up.
have to be rich, by the way.
Nope, as part of the probate process, and you got to have money to deal with those things. The big one that gets used in financial planning circles is transfer taxes, the estate tax, which most people look at and go, I'm not that rich, so I don't have to worry about that. But there are a number of things that will happen. Court filing fees, for example. Now, there are some cases where attorneys may float that expense and then extract it from assets of the estate later. But there are other situations where you may need to come up with the money to move forward. And having liquid value, which death benefit is extremely liquid, gives you a lot of liberty to choose how you want to address the situation.
Exactly.
It also makes it easier to deal with situations like mom and dad had a piece of real estate.
Mm-hmm.
And
like the situation we were just talking about.
Well, and I'm not talking primary residence. Could be, but let's, they got a piece of real estate. It's got a loan on it.
Mm-hmm.
Not a big loan, but there's a loan. And when the last one dies, the bank says, we need the loan paid off.
Right.
Because you don't get to, in most cases, just go to the bank and say, okay, I'm going to make the mortgage payment for mom and dad for the next couple of months while we sort this thing out. That's not how mortgages work. So in a lot of cases, you need to satisfy the remaining balance on the mortgage immediately because they are callable. And that could create a lot of stress.
Yeah.
In a situation that's already stressful.
Yep. Absolutely.
Okay. Longevity risk. Now the insurance industry is going, oh, okay, yeah, that's something we're talking about. So longevity risk is simply the risk that you live longer than you expect.
Yep.
And life insurance is a really great way of addressing this potential problem because there's an ability to refill the coffer, so to speak, with death benefit.
Mm-hmm.
It allows people to be more cavalier is not the right word, but it's the one I'm going to use in this case, with their spending of other assets because they have life insurance to back it up.
Yeah. I heard someone in our industry say years ago, it sets the hostages free.
Yeah.
Because many people will earmark money like, well, I can't touch that because I want to leave that behind, which is perfectly noble. Nothing wrong with that. But many times it leaves people in a situation where they're doing without because they're concerned about their legacy.
Mm-hmm.
And life insurance takes that off the table.
Yep.
Or can.
Yes, it does. It also gives people more permission to go out and, let's say, purchase something like an income annuity.
Yeah. Yeah.
To significantly reduce the stress that they face when it comes to managing a portfolio. And in a lot of cases, people don't want to do that. So I buy the annuity and I own life insurance knowing that that's the money that I'll leave behind.
Right.
And now I don't have to worry about what's going on with the market and whether or not I'm selling too much of my assets or I've got the right income producing assets set up. I just have the income from the annuity and the life insurance will go to the kids.
Right. Yep. Very simple.
Next on the list, long-term care.
Mm-hmm.
So a lot of life insurance policies these days come with a rider that give the owner of the policy access to a portion of the death benefit if they become what we call chronically ill.
Yep.
Chronically ill is basically what would qualify you for long-term care insurance. Now, one important differentiator with life insurance and these riders, most of the time, it needs to be a permanent condition.
Right.
Whereas traditional long-term care insurance wouldn't have that requirement. But you can use life insurance in this case as an additional way to defray the expenses that are associated with long-term care.
Right.
So what could realistically happen is you own life insurance. Let's say you bought it to buffer sequence of returns risk. That was something that you realized, thought about, said, this is what I'm going to do. You get to retirement. You have the enviable luck, fortune, that's what I want, to not really face a sequence of returns issue. For the first 10 years of retirement, the market booms. And you're able to use your stock-based assets to generate income, and you've got more money than you thought you were going to have at this point. Time goes on, you still own this life insurance policy. All of a sudden, something happens, and now you're in a situation where you might need to start looking at nursing homes.
Right.
You have the death benefit of the life insurance policy as an additional arrow in the quiver to deal with the expense, and you don't have to be as worried about what this is going to do to your other retirement assets.
Right.
The cool thing about life insurance is that it is adjustable based on all these things we've already brought up. And I'm not going to say it's going to solve every one of these risks if they all hit you at once. That's not likely to happen. What it can do, though, without having to make any additional purchase of more policies, is deal with these situations as they come up to you. Because you don't know which one you're going to face. You're probably going to face at least one. And that's when life insurance can come in to help.
Yep. Exactly. And I will say some policies are more engineered for this than others. So
yes,
if that's a primary concern of yours, then you should vocalize that when you're looking.
Yep.
Because some of them are, well, I guess I'll just make it simple. Some are much better at generating cash value, while others are much more adept at dealing with long-term care situations, and they may not be as adept at accumulating cash value.
Right. If you are out buying a life insurance policy specifically for the chronic illness benefit, or there are long-term care riders, bona fide long-term care riders on life insurance policies now, that is not necessarily going to be a policy that you purchase because it's going to give you the best cash accumulation you could ever get.
Right. Exactly.
Okay. Last one on our list is basically the risk of you being you.
I didn't know we could buy insurance for that. I need some.
Or at least your wife thinks so.
Yeah.
So I think people sometimes get a little offended when we bring this up, but trust me, the day will come where you will cause more damage to yourself than anything else going on around you.
Mm-hmm.
Because
we speak from experience.
Yeah.
From our own personal.
Yep.
We're not talking about other people. We're talking about ourselves.
Yep. Things can get scary.
Yeah.
Decisions can be made in a moment where you don't really have enough time to think through all the scenarios.
Right.
And we've known forever that selling in a down market to try and mitigate losses doesn't work. It is the surest way to deplete your retirement assets.
Yep.
And yet every time we head into a market decline, it is accelerated by selling.
Right.
By people trying to stop the losses.
Mm-hmm.
And that's only one example, but this is what I'm talking about when we say people being people. If you have a position in cash, like life insurance, and a market decline unfolds, there is far less anxiety you face knowing that you have this other position that's not going to decline with the rest of the market.
Right. At least that's what you should be thinking.
Mm-hmm.
Yeah.
And that gives you a certain amount of insulation from those problems and buys you the requisite amount of time to sit through the recovery in a lot of cases.
Yeah. Yeah. I mean, well, think about people that were, I realize it's specific markets because real estate is very market dependent or locale dependent, I guess I should say. But everyone's seeing all the headlines right now about declining real estate prices in Florida.
Yep. And
you were thinking about selling your house to fund your retirement and moving somewhere else that was less expensive. Well, now may not be the best time to do that.
Yeah.
And so you don't want to back yourself into a corner where that's the only option you have. If that's the only option you have, it is what it is. But
right.
This happens in all sorts of markets.
Yeah. I do want to differentiate the sheer difference between the mathematical side of something like sequence of returns risk and the emotional side of this, the risk of you being you.
The behavioral
because
risk.
They're different. Mm-hmm. They're very different.
Mm-hmm.
And that's the key point that I want to drive here, because I don't think a lot of people necessarily think of it in this way, that sometimes what's going on is nowhere near as bad as you think.
Right.
But you make a decision that ends up being a pretty terrible decision.
Yeah.
Because of what you perceive to be the circumstances.
Right. Or maybe if you just sat on your hands for a couple of years, things would look different.
Or a couple of months in some cases.
Yeah.
So,
or weeks in some cases.
Try not to get personal, but thanks. So, a couple of parting thoughts here, just important things to mention, that this whole time we've said life insurance. We've not specifically really talked much about whole life insurance or indexed universal life insurance, but that is primarily how we see this unfolding for people.
Yeah, because they both work.
Whole life insurance, the much stronger guaranteed side of it, though universal life insurance, indexed universal life insurance comes with a very strong dose of guarantees, or practical guarantees, all on its own. And design really, really, really matters here.
Yeah.
So the whole life policy that Jake's company sells is not exactly the whole life policy that we're talking about here.
Right.
And that's not to say that Jake's a bad guy or anything like that. That's just to say that specific example doesn't necessarily work great in the context we're talking about it.
Right.
So don't assume that whole life insurance is whole life insurance is whole life insurance, nor should you assume that indexed universal life insurance is indexed universal life insurance is indexed universal life insurance.
Right.
They are different.
Right. One more point that I had to add as a final thought, and that is, and this is something we've said before, but if this is something that you think is interesting and it might work for you, do it sooner rather than later, because it doesn't work as well if I'll just use, traditional numbers. If you wait until you're 65 and you go, I'm retiring next month, I want to get one of these life insurance policies so we can do all these things that we've discussed. The answer is probably going to be, in most cases, it's not going to work out that well for you at this stage.
That is very true.
So and this is one of those retirement portfolio strategy, things that goes in the retirement portfolio that you kind of need to think about. I don't know if there's an exact number of years before you retire, but the longer you give it, the better. And more full the options that we've mentioned will be to you.
We've generally told people that from at least the standpoint of using the cash for income as an example, you're going to need at least 10 years.
Right.
So that doesn't mean 10 years prior to retirement and no time after. You could retire, buy life insurance, and just use other assets. That could be something you do. But this is definitely something that favors the person who moves on it early.
Yeah.
And even if things are not ideal, like I would like to free up a little more money and buy a bigger policy. Now that's great. But trust me, if that doesn't happen and you then spend the next 5 years waiting for this perfect time to come, you will have accomplished a lot in 5 years with less money going in.
Yeah. That's true. Very true. All right.
Okay. That's it for today. I am Brandon Roberts.
And I am Brantley Whitley.
Thanks so much for joining us, and we will see you next week.